In the world of high-stakes global trade, the price of admission to the American market just jumped by, well, $200 billion. And with that, jobs and factories are shifting right across the Atlantic. Welcome back to the Deep Dive. Today, we are really focusing on one of the most stunning trade victories in, I think, recent history. Our mission is to understand how the U.S. government leveraged some truly aggressive tariff rates, essentially creating an economic gun to the head of one of the world's most prosperous nations, Switzerland, and forced a fundamental restructuring of their entire economic relationship with us.
Exactly. This isn't some theoretical, free trade debate in a classroom anymore. We're looking at cold, hard outcomes. Washington managed to turn what was an unprecedented economic threat into an absolutely quantifiable long-term economic commitment. And that secures massive benefits for American manufacturing.
Right. So the core question we're trying to answer today is this. How did an initial, just crushing, 39% tariff rate manage to transform into one of the largest foreign investment pledges in recent memory? We're talking $200 billion earmarked for American manufacturing and all the critical jobs that come with it.
Yeah.
Let's get into the mechanics of this. Okay, so to really grasp the shockwave the U.S. created, you have to look at the playing field just a year ago. Switzerland was, by all accounts, a model of open trade. I mean, up until January 1st, 2024, they had abolished all industrial tariffs.
All of them. And that meant that an extraordinary 99% of American manufactured goods were just flowing into Switzerland, completely duty-free.
So they were benefiting from that openness.
Hugely. But it also made them uniquely vulnerable when the U.S. decided to, change the rules of the game. And that vulnerability was exploited almost immediately. Effective August 7, 2025, the U.S. imposed a devastating 39% additive tariff on nearly all incoming Swiss goods.
39%. Just stop and think about what that does. If you're a Swiss watchmaker exporting a luxury watch to the U.S., let's say it retails for $10,000, that tariff instantly adds another $3,900 to the cost.
Right, before it even hits the shelf.
It's just uncompetitive at that point.
It wasn't just uncompetitive. The sources we're looking at describe this tariff as an immediate, insurmountable competitive disadvantage. They call it an existential threat. And we aren't just talking about chocolate and watches, though those were hit hard. This rate targeted the really vital Swiss sectors. Pharmaceuticals, specialty chemicals, high-precision instruments. I mean, these are businesses built on very fine margins and decades of branding. A 39% tariff is a death blow to that model.
And you can see how seriously the Swiss government took this threat just by looking at the financial projections. The policy was expected to cause a minimum potential loss of 0.6% of Switzerland's entire GDP.
0.6%. For an economy that stable and wealthy, where growth is measured in tiny fractions, a projected 0.6% contraction is, well, it's enormous.
That's the kind of pressure that completely shifts a nation's foreign policy priorities practically overnight.
Exactly. It forced them to move, and to move fast. When the world saw the U.S. apply that punishing pressure and stick to it, Switzerland really had no choice but to get serious about a compromise that would satisfy Washington's demands.
And here's where the strategy just paid off beautifully. The pressure only lasted a few months. By November 2025, a new framework agreement was hammered out. The U.S. agreed to lower the tariff rate on Swiss imports from that crippling 39% all the way down to 15%.
Yeah, that 15% is the relief for Swiss exporters. But let's be crystal clear about what that relief cost them. The price was the pledge. In exchange for that tariff reduction, Switzerland committed to $200 billion in new U.S. investment by the end of 2028.
$200 billion. That's not just symbolic capital, that's a fundamental commitment to shift manufacturing capabilities over here. The deal explicitly incentivizes major Swiss companies, pharma, instruments, to build manufacturing plants in the United States.
Right. And that is the definition of leveraging economic pressure into domestic job creation. It's strategic leverage in action. Some pundits initially argued that the U.S. capitulated by dropping the rate from 39%. But the reality is the lower tariff was just the vehicle to get the real prize.
The investment.
The investment. Washington successfully traded a high, unsustainable tariff for a guarantee of capital, jobs, and the physical relocation of supply chains onto American soil. And that relocation is huge.
Yeah.
When you talk about pharmaceuticals, you're talking about securing essential medicines at home, minimizing geopolitical risk.
Absolutely. The $200 billion is the headline, but the stability and security of having those advanced manufacturing facilities here, that's arguably the deeper win. But we do have to address the elephant in the room here. The $200 billion commitment is on the table, yes, but 15% is still a massive increase over the old free trade environment. What about the durability of this deal?
That's a necessary point of caution for you to understand, for sure. Even with this huge win, the long-term stability is, well, it's uncertain. There are pending proceedings before the U.S. Supreme Court questioning the fundamental legality of how this entire tariff strategy was deployed.
So, if the Supreme Court were to invalidate the president's authority to do this, what happens to those commitments? Is that $200 billion dollars truly guaranteed if the legal foundation of the whole deal just dissolves?
That's the critical question. I mean, signed commitments carry weight, of course, but if the entire regulatory landscape gets overturned, it creates massive instability. These big Swiss drug manufacturers have already factored this 15% rate into their business plans. They're planning new U.S. facilities. If the courts intervene, they might try to walk it back, but a lot of that initial capital and planning is already in motion. For now, the commitment stands. But that legal challenge adds a layer of risk we just can't ignore.
The Swiss case really provides a perfect, successful template for understanding the broader shift in U.S. trade policy. This wasn't just a one-off negotiation. It's clearly part of a deliberate strategy being deployed against major economic partners.
Oh, absolutely. If we zoom out and look at the bigger picture, the U.S. is applying this kind of pressure across the board. For example, President Trump signed an executive order imposing a minimum 10% tariff on all U.S. imports. But the European Union, which is a much, much larger trading bloc, is facing tariffs at a higher 20% rate, effective in April 2025.
And the EU is a giant. Their bilateral trade relationship with the U.S. is the world's largest. It totaled a staggering 1.6 trillion euros in goods and services in 2023.
A massive number.
Yeah.
You can't move the needle on that without huge global repercussions.
And the sources show the EU is taking this threat very seriously. They've launched public consultations on countermeasures. They're preparing WTO litigation.
What's fascinating here, though, is the comparison. The 20% rate for the EU versus the 39% used against Switzerland. The U.S. likely couldn't start at 39% with the EU. The immediate retaliation would be too destabilizing. 20% is that pressure point. It forces them to the table without causing a full-blown, immediate trade war. But the goal is exactly the same: leverage.
And this new aggressive use of tariffs, it contrasts so sharply with the older model of trade policy America used to favor, which often relied on, bilateral investment treaties?
BITs. That's right. Before this new tariff strategy, the focus, guided by those BITs, was all about protecting American investment once it left the country. The goal was to set up clear, protected rules for American capital flowing out to foreign markets.
So those treaties were essentially insurance policies for our companies.
Precisely. They were insurance. A BIT ensured that if an American company built a factory overseas, the local government couldn't just seize it without paying fair market value. It also ensured that profits and dividends could be transferred back to the U.S. easily. It was all about safeguarding capital we sent away.
Okay, so the old model was security for offshore investments, but this new tariff strategy is all about compelling inshore investment.
That is the fundamental difference. The core goal of U.S. policy remains the same: maximize and safeguard the flow of American capital and jobs. But the method has changed dramatically. Tariffs are proving to be a much more direct, faster, and frankly a demonstrably successful way of compelling foreign nations to invest their capital and build their factories here, rather than just letting the old status quo of globalization continue unchallenged.
So what does this all mean for you? The core takeaway from this deep dive is that this aggressive trade action, it worked. It successfully converted a wealthy partner's economic vulnerability into concrete commitments for domestic U.S. manufacturing. We didn't just win a tariff skirmish. We secured a massive, quantifiable win, that $200 billion payday, and the relocated supply chains it represents.
Right, and this is the structural shift we all need to be paying attention to. Think about it. If a nation like Switzerland, which already provided almost total free trade, concedes $200 billion and shifts critical manufacturing here under this kind of pressure, the precedent has been set. So the real question now is, what incredible leverage does this tariff model give the U.S.? Enforcing similar job-creating changes among much larger partners. I'm talking about the European Union. The success against Switzerland has proven the strategy works, and how the U.S. chooses to apply it next. That is the question that will define the next decade of global economics.